Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, what's going on? Welcome into Phil's Tax Hacks and Other Retirement Facts with Phil and Mark here to talk about mastering retirement cash flow. This is probably part one of, it's kind of a multi-part series here. We're going to see how it goes today. We may do this into two parts. We may do part one in two parts, and then we'll do part two in July. So there's a lot going on in this topic we're going to get into. So make sure you're subscribed to the podcast on audio version or video version, whatever it is that you like to use, whether it's a YouTube, you can find us on there, or Apple or Spotify or Google on the podcasting apps. Just type in Phil's Tax Hacks under the search box. But yeah, we got a pretty big content conversation we're going to have here, Phil. Really understanding changing expenses and really just cash flow, right? Cash flow is king.
Cash is king. I mean, that's what it's all about when you get to retirement.
Even though we're trying to
your life accumulating, assets,
right.
But at the end of the day, the accumulation doesn't matter. Now how do you convert that into cash? What do you?
Right. Yeah. Well, it seems like they want us to
retirement is that.
It seems like they want us to go to a cashless society, but yet cash is still king, right? So
yeah.
I
think cash will always be king at some point. So.
I don't know. They're trying hard, but anyway.
They are trying really hard. That's a whole nother discussion to get into.
A whole other discussion. I got to go off on a rant for just a quick second. So I saw this video yesterday of, I think it's in a Middle Eastern country, and it's the largest tire cemetery in the world. It's just tires after tires, and it's burning all the time, right?
Yeah.
Which is, burning tires is like the worst.
Toxic, right?
Right. And yet, the conversation is like Ireland's going to kill 200,000 cows because of climate change. 200,000 farting cows
just burning.
Yeah, is somehow more damaging than a tire field on fire. I don't even know where we've jumped the shark.
Yeah, sometimes I wonder. I think
we certainly have jumped the shark. Yeah, definitely. And I know that's a little bit off on a rant for a second, but it's like we're always seeing stuff, right? It's always something going on. We're just kind of getting overloaded. And at the end of the day, back to this kind of the point of the cash as king, it just seems like there's agenda to kind of remove cash, but I just don't see it happening. And it's going to be certainly going to be a challenge because people are just, we just feel better with having cash,
Yep.
You can't go the gold route. You can't shave off a chunk of gold if you're trying to go buy some bread, right? So
yeah, that's right. Yeah. Little shavings, have the weight out there. How much is this?
scrape, and here you go, right? So anyway, in this episode,
the wind doesn't come up.
That's true. Well, in this episode, we're going to explore many of the expenses in your life that you might drastically change one way or another. So we're going to break these down a little bit. And like I said, this is pretty intensive stuff we're going to go through here for the next couple episodes, folks. So definitely consider, checking back in with us and checking these podcasts. And the great thing is you can pause, rewind, whatever the case is on any platform. So what are some of the expenses, Phil, that might drastically change one way or the other in retirement for your clients? Let's start with, I've got several bullet points here. Let's start with housing.
Yeah. So, a lot of times housing is something that's going to change. You're maybe have been in the house you're in for the last 20, 25 years. That's where you raised the kids.
Right.
Maybe it's a colonial and you don't need all the space anymore. You don't want the stairs. That's, probably the most common thing I hear is that, hey, I'm getting older, the needs aren't quite as good as they used to. I'd like to get everything on one level. We've gone through that, with my wife has had some knee issues.
Mm-hmm.
So we went to a ranch a couple of years ago. That a lot of times is the discussion of, okay, I want to downsize, quote unquote, from maybe a footprint standpoint, go into more of a ranch, get it all on one level.
Mm-hmm.
But yeah, it's interesting as you get into housing, because even that concept of downsizing doesn't necessarily mean downsizing from a price.
True. Right. And so obviously the big thing that many retirees and advisors, go back and forth on is to pay off the house or not to pay off the house.
Right.
And I just actually had an email question on another show I was doing the other day. And the lady was saying that she inherited some money and it's enough to pay off her house. And so, but her mortgage is only, and she's still got a good mortgage from before the rates went up.
Right.
And she's still like 3%. And so she's like, hey, should I put this money in something that's getting me 5%? Right. And that's a really interesting balance because this is where cash flow comes back into this conversation, because maybe you need to make sure you have enough of an emergency fund or whatever. Don't just take all that money and dump it in the house, because you can't pull money out of your house.
Yeah, and that's we have that discussion a lot of times with clients when we're talking about housing. Is the mortgage, is in some clients that's just a goal, they want to pay it down.
Sure. Right.
And a lot of times in finances, you run into these scenarios where I say, hey, there's two sets of rules. There's the head rule and the tummy rule.
Right.
So the head rule is the math. I mean, I can run the math and tell you what would make sense mathematically. Like in this case, personally, my preference on this, when you run the math, as long as you have a good interest rate and that payment is manageable, I'd prefer having the liquid asset, the cash available, and keep the mortgage.
Yeah, what is it? Keep some dry powder, right?
Yeah, I mean, now you've got more flexibility in the future if things come up. If there's something you want to, additional purchases or expenses or whatever it is, you have more flexibility. And if you've got a great rate, I mean, to the point of the email question that came in, I mean, why would you take something and pay off a 2.5% mortgage?
Right. Yeah. So it's always
a guaranteed rate, at that point versus, what you might invest in. So you have to look at that too. But that's where the tummy rule comes into play. Some people just say, hey, you know what? I would just love not to have a mortgage.
I want to wake up and be like,
fine. Hey, let's do it then.
Yeah. Let's wake up and know this joker is ours, right? We don't have to deal with that.
That's right. We don't have to worry about what happens. Yeah. Housing is a very interesting topic when you get into retirement, because there's a lot of things that change. The mortgage, potentially, maybe you're on the tail end of it. Maybe then it might make sense to just pay it off if you only got a couple of years left and you got some cash available, just be done with it. That way you can kind of make a fresh start of what the cash flow might be.
Right.
But if you get into changing housing, then that's a whole nother discussion to get into, because now, and we've talked about this several times, that, often downsizing, quote unquote, in size might not be downsizing in cost, and how that plays into it.
Yeah. Good point.
And then you've got the moving and all the other expenses that go into that. So.
Okay. All right. So you got to consider the cash flow element when you're talking about your house, right? And of course, the big thing for most people is going to be, are you getting rid of all your cash just to pay off the mortgage? And is that really the best move? That's usually where most people are going to get stuck. So considering that one in there, no more work stuff is number 2 on here. And like this could be like my brother, we use him on the show all the time as an example. He's been working from home now for a couple of years. And he's just like, he went and got his oil changed in his car. And he's like, I barely even got to the mileage to change the oil. He's like, but I went ahead and did it because he's just not driving. So, and he's still working. So he's doing that home thing. But when you go to retirement, you don't have the commute anymore, and things like that. The gas bill.
Right. Yeah. I mean, and this is a discussion we have with a lot of clients is, what will change? Maybe you're both working, you have 2 cars,
right?
Or maybe even 3, maybe you've got
big gas bill
because you just do a lot of travel. That's the work car, and you drive an hour to and from work every day. And that's the one you rack up the miles on.
Right.
So yeah, maybe you're going to downsize to 1 or 2 cars, and definitely if you're doing a lot of driving, that's going to drop the gas bill, insurance. Make sure you talk to your insurance agent about that, because
eating out. I mean, go to lunch.
Goes from, being a 50 miles each way.
Oh, yeah. Yeah.
Versus it's a leisure vehicle. I mean, that changes the insurance rate, because they know you're not on the road as often.
And that's a good point. Yeah. Like I think you know, 15,000 a year, you could drop it down to 10,000 or 8,000 or, whatever that is. And then, of course, when you're at work, like, started to mention, you go out to lunch, which is more driving, which is also spending, food, money on lunch. So,
and depending on the work, clothing and attire you have to wear, maybe that'll change. So
I can change your cash flow once you get to retirement, right?
And I mean, we should have mentioned in the beginning when we're talking cash flow. I mean, my preference is always, when you're looking at this whole concept of cash flow, is, rather than try to sit down and add up, well, this is what it's going to be. This is all the fixed expenses, all the different things, because we just don't know, right?
Right. Sure.
We're human. We don't pick up all the things we're spending money on. So start with, what do you have today? What is your net spendable income today?
Right. That's
lifestyle. So let's start with there. Now let's make some of these adjustments. Okay. Housing is part of that. Now let's pull housing out. And when we're running our financial plan, we always pull housing out, because several things. The mortgage is fixed, right? It doesn't change every year, but the rest of it should have inflation. And if you're on a mortgage that's nearing payoff, at some point it's going to drop off, but now we can pull out, okay, let's pull out that work stuff. That's going to be different. So let's start subtracting and or adding to what your base level of expenses are, to come up with a true accurate picture of what that would be.
Okay. So, yeah, that makes sense. And of course, each of these is going to factor into
that's going to be part of those adjustments. So
yeah. Healthcare. That's the next bullet point on my list. Obviously, this is going to get a little bit more dramatic. The more things that need fixing, right?
Yeah.
you got to repair a shoulder or a knee, your wife's knees, right? Whatever the case is, right?
Yeah. So healthcare is, again, another one of those big changes as you get into retirement, depending on what age you're retiring at. Again, another factor, another expense item that we always break out separate because of those changes over time. So right now, if you're employed, you're probably under work coverage, and
right. Yeah.
Depending on your job and the company you're at, you may pay very little for good coverage. You may pay a lot. It's all over the board, especially since the Affordable Care Act came through.
Right. Oh, yeah.
Companies have had to do to even provide health coverage. So you're going to have to understand, well, yeah, in my budget today, I'm paying X amount out of pocket, and here's my deductibles and copays, my exposure. Mm-hmm. And as you start comparing into, again, depending on when you retire. So if it's prior to 65, well, how am I going to bridge that gap?
Right. Right.
And that's always the challenge in pre-65 is, okay, I've got, 2-3 years, whatever it is, to 65. If I'm not working, I no longer have work coverage.
How do I shore up that gap?
How do I shore up that gap? Is it going to be using the Cobra? I couldn't think of it there for a minute.
Sorry.
Cobra, which is one of those things that used to think in the past.
Well, you typically would be like, no Cobra.
That's expensive coverage. Well, the reality in today's environment is it's probably cheaper than what you're going to find in the marketplace, and it's probably better coverage.
Yeah.
Which is totally mind blowing, but that is
a little weird. Yeah.
So you've got 18 months of that. But then beyond that, what do you do? So now you're into the marketplace, whatever it is. So you got to look at that. And then that can be an expensive time.
Yeah, that's a good point.
Often, once you get to 65, healthcare, again, depending on what you're used to paying, it can be much more affordable in retirement. Yeah. So typically what we budget is around $300 per month per person for Part B for Medicare, which is $164.90 right now. Plus, then you're going to have to pick up like a supplemental or a prescription drug plan, or maybe go into an Advantage plan. I mean, that's a whole nother show we can get out of in the whole.
Probably should, really, yeah.
Yeah. But yeah, Medicare or health, health coverage, that should be a whole separate discussion. And how does this map out? And often these different expenses have different phases as you get into retirement, especially like healthcare. You're going to have these phases you might go through. And then if you and your spouse are different ages, well, you're going to enter these different stages at different times. So,
and often the premiums, you think about the different premium payments and we get the COLA adjustments for Social Security, but a lot of time that gets eat up with whatever adjustments they make to Medicare.
The Medicare costs, yeah.
Yeah. So,
although sometimes like this past year was a crazy year, Medicare Part B actually went down.
Right. Yeah. Which doesn't happen often.
And Social Security went up.
Yeah.
So
which doesn't happen often. Yeah. I think that may be one silver lining to the inflation, right?
Yeah. Yeah.
All right. Taxes. Next bullet point on my list here. Obviously, clearly, when you're talking about cash flow, taxes can be, a huge component of what you're going to be doing. Not what you make, it's what you keep, right?
Right. Right. Yeah. And taxes we've talked about it a lot. It's a huge part of the financial plan. Mapping it out. Again, at a high level, comparing working versus retirement, in general, taxes will go down because you're not paying Social Security and Medicare anymore.
Gotcha.
So on your wages,
in theory,
paying, well, you shouldn't be unless you're working.
Well, okay, yeah, true. Yeah, I got you.
You're paying right now as an employee 7.65%, and 6.2 of that's the Social Security, and that can go away once you reach a certain level. But
right, okay,
roughly call it 7.5%, almost 8%. You're paying in Social Security and Medicare on earned income on your wages.
Gotcha. Okay.
Well, if you're no longer working, you don't have earned income. Your income's now coming through Social Security. Maybe it's a pension. You're taking, you've got interest dividends, IRA distributions, rental, whatever it is. All those types of income are not subject to Social Security and Medicare.
Okay.
So from a big picture tax standpoint, yes, those taxes go away. So yeah, your taxes technically go down. But we've talked.
I was gonna say, I wonder if that's what feeds into some of the misnomer that will be in a lower,
It may, but you got to. If it's phrased, you're going to be in a lower bracket. No,
that's a whole discussion. If you're just going to have lower taxes. Brackets.
Yeah, if you're talking lower taxes, then yeah, I can go along with that because you may.
Okay.
Because you don't have Social Security and Medicare.
Gotcha. Okay, I'm tracking. Yep.
But yeah, the whole tax bracket discussion and what does that look like in retirement? Well, that's one of those discussions that has to have a broader, longer time horizon to look at, because early stages of retirement, you may actually be in a quote lower bracket, even depending on where the money's positioned,
where it's coming from,
from,
Yep.
But as you get into further stages of retirement, delaying Social Security. So if that kicks on, at 70, well, now boom, that's taxable income. Once you hit RMD at 73 or 75, well, there's another bump of income. We've talked about it many times that ultimately you might get pushed into these higher brackets, later stages of retirement.
Yeah, especially if you're letting the tax deferred things grow.
Yep. Yeah. So, I mean, it is definitely something you have to understand. What does your specific picture look like? Don't use an estimated and average, my effective rate. That means nothing. Map it out and understand what your marginal rates are. Where are you truly going to be for you? Don't talk to your buddy and say, hey, what tax, what are you paying?
Bracket you it.
Yeah. It doesn't matter. What do you, what's your makeup of income?
Yeah.
How much do you need? And look at that specifically. But taxes are definitely an area that is overlooked in retirement. And there's a lot of opportunity. Don't think they can control it. And there's a lot of ways to manage and control and manipulate that tax burden. So.
And if we're talking about understanding changing expenses when it comes to our retirement cash flow, it's going to play into my next one, which is the retirement savings. Because one of the things that we're doing, obviously, is we're paying our future self, right? While we're working, we're paying, well, we better be anyway. Hopefully we are.
Right, yeah.
We're paying our future self. And that's going to change to the point you were just kind of making a little bit there. When we no longer have the job, when you're no longer pumping into the 401k and stuff either.
Correct. Yeah. So you can't, when you're looking at my, working income versus my retirement income, you can't look at the gross. I always look at the net spendable income. And so your net while you're working should already be after all those contributions. So I mean, you might be grossing 150,000 a year, but by the time you take out Social Security, Medicare, all the taxes, contributions to 401ks, everything else, maybe you're down to, spending $80,000 net a year.
Okay.
So if we're trying to net 80,000, that's a different discussion to have. That's already taking away those retirement savings. So you can't look at, what do I need to net during my working year? If I'm contributing to a 401k, I might need 150. But if I need to net 80 in retirement, well, maybe now it's only 100. Because I don't have some of these other items, contributions to 401ks and the retirement plans.
Not on the list anymore.
Right.
Yeah.
So I always look at, we start with a net.
That's extra dollars in your pocket.
What's the net? Well, yes and no. I mean, again, it's the way I look at it, right?
Okay.
I ignore the gross because it means nothing. What are you spending? What is the net spendable income on all the different items? Because in this case, that's already taken into account. Of that line, so to speak, is the retirement.
Oh, yeah. Okay. Yeah.
So if we come down to here's my net, this is what's hitting my bank account once a month or every 2 weeks, whatever it is, however you get paid, that's what you have to spend.
Okay.
So if we're trying to replace that in retirement and then make the adjustments, we've already accounted for that.
Yeah.
So again, perspective, just what you look at. Don't look at the gross, don't think, I'm making 150, so I got to make 150 in retirement to have the same lifestyle. Not necessarily, because then absolutely this comes into play. You're not contributing to the 401k anymore, so let's drop that down. Yeah,
no, that's a great point. Yes, so thanks for breaking that down. It's a good way to illustrate that, which is the whole point of the podcast. So, all right, travel and leisure, right? So, they're taking my every Saturday's a retirement. Every day's a Saturday.
Every day's a Saturday. Yeah.
Right. Exactly. So it is right. So extra expense in a different direction.
Yeah, and this goes.
I was saying some of the things that may be saving us some money. This is going the other way.
Yeah, so this is back to that discussion of what does your retirement look like? What's that vision of retirement? And this is for married couples. You guys need to have this discussion early on to say, okay, when we retire, what does that look like? What are we going to do?
What are we doing?
What's your hobbies? What do you want to do? Is it, hey, I want to travel a lot. That's my passion. I like the golf. Whatever it is. Understand what that looks like. And yeah, it can be more costly, especially if it's travel, leisure, hobbies, things like that, because you have more time to do it.
Well, yeah. And that's the whole point. The bucket list stuff.
Right. Yeah. A lot of times those bucket lists gets put off till that time. And we talked early on when we were talking about healthcare that there's these phases maybe in retirement. Well, travel and leisure often is one of those phase type scenarios.
It's an earlier, heavier phase.
Yeah, we're planning for clients. A lot of times we're, building in a heavier travel budget, maybe for the first 10 years or 15, depending on what their age and, their desire is from a travel standpoint.
Sure. Yeah.
But typically it's going to be more heavily weighted in those earlier years when you're more capable. You know, maybe you have the desire, that bucket list, so to speak, but after you've done it for 5 or 10 years, it's like, I think I just want to, spend some more time at home or do, whatever it is. So
how many times can I go to Vegas or whatever?
That's right. Kind of the, how many cruises can I take?
Yeah.
So.
Yeah, exactly. All right. And then our final one, and I think, Phil, what we are going to do is we're going to just kind of cover the bullet points that we covered here as far as thinking about the way it's going to could affect your cash flow. And then what we'll do for next week's episode, we'll come back and just kind of talk through assessing the retirement expenses and just kind of how it's going to kind of typically work out. Sure. And I'll go through some kind of questions that you would be posing to your clients and things of that nature. So the last one here on the different categories. So we did housing, no more work stuff, healthcare, taxes, retirement savings, travel and leisure, and then insurance. So might we save some money here from a cash flow standpoint, or might we be going the other direction on when it comes to insurance?
Yeah. So insurance outside of healthcare, we talked about that as a separate line item. So this is more the other types of insurances, so
car, house.
Yeah, car, house. We talked a little bit about car, that might change. House probably isn't going to change, right? I mean, typically is going to go up depending on if you move. But this is going to be more kind of the work. Maybe you think of the work type insurances you might have. So long-term disability.
Okay.
Right. So, I mean, the whole purpose of long-term disability is, hey, if during my working years I can no longer work, well, it's meant to help replace some of that income. Well, once you retire, you're no longer working. So they're not going to pay you for disability in retirement. That just doesn't work that way. So in fact, most disability stops at 65 anyways.
So if you're having to pick up this coverage, your expenses could be going up.
66 full retirement. Yeah. Yep. So, I mean, it could go up from an expense standpoint. If you're disabled, that's a whole discussion to get into. From a cost of insurance standpoint, your disability insurance is going to stop, so if you're contributing to that, you don't need it anymore. And that's really something, maybe even looking as you're approaching retirement, you might need to start looking at paring that down, because the number of years that you need that coverage for is going away, right? It's small.
Yeah.
Life insurance is another one, that depending again on when and how you've assessed the life insurance, you may not need it. So it might be an expense you had earlier on that you no longer need. But I want to stress a point here that there's all these general concepts in retirement, right? One of them is with life insurance. We
don't need it.
Yeah. No, I don't need it. I've accumulated everything I need, so I don't need it.
The kids are grown. I don't need it. Yeah.
I don't have college anymore. The kids are growing. All these other things. Be very careful. Run the math. Understand what happens if you pass away, because your surviving spouse is going to lose income as a household. One of the Social Security benefits is gone, the smallest.
Yeah.
And as a surviving spouse, that spouse is now going to be single. So their tax brackets get condensed. So from a total tax standpoint, they're probably going to be in a higher bracket.
Yeah. And, and it could be
run the math on it. And we do this with all our clients when we're planning is, what does it look like if you pass away today, 5, 10, 15 years into retirement, to see, do you truly need life insurance before you just take the assumption that, I'm retired, I don't need that anymore.
Yeah. For many people, I mean, again, every situation is different, but life insurance could be a very useful tool for a number of things you're trying to accomplish, in retirement or even after you're gone, right? It's not necessarily just the death insurance.
Right. Yeah. And there's all sorts of other uses to get into life insurance on, but just from a true death benefit replacement of income, to be careful in making that general assumption of, I'm not working, so I've accumulated, I don't need it anymore. Okay. Understand the bigger picture of what it looks like for that surviving spouse.
Okay. Well, so we went through the categories then again. So what we'll do is we're going to go ahead and wrap this up this week. We'll come back next week. So make sure you subscribe to us, and we'll talk about, as you're assessing the retirement expenses, breaking it into at least 2 categories, the must haves and the nice to haves, Right. And so we'll kind of go through that a little bit. And I got a couple other questions we'll kind of break down and jump into a little bit. So again, if you got questions when you're thinking about, all right, how's my cash flow going to look in retirement? Cash flow is king, right? Cash is king, all that good kind of stuff. These are some categories that may shift one way or the other. And it's good to have a strategy and a plan in place to make sure that you're being as effective as possible. And that's, again, what a whole, retirement strategy is all about. So get yourself on the calendar. If you're not doing so, talk to a qualified professional. as long as they're a qualified professional, talk to somebody, right? It doesn't have to necessarily be Phil, but of course, obviously we're doing the show. So if if you're interested in what Phil's got to say, give him a call, stop by the website, whatever you like to do, but certainly do something for yourself by talking to a qualified pro. If you've not done so many people get that eye-opening aha moment when they finally sit down with a retirement planner and go through the process and be like, oh, wow, I didn't realize there were all these pieces to it. So do yourself.
I hear that all the time. So
do yourself and your retirement a favor, folks. Give Phil a call, 248-888-7530, 248-888-7530. As always, there's no cost or obligation for a consultation. So why not, right? Reach out to him, give him a shout, say hey, or stop by the website, philstaxhacks.com. That's philstaxhacks.com. And we'll be back next week with another episode. Phil, thanks for hanging out, bud.
Thanks. Have a good day.
Yep. We'll do it again next time right here on Phil's Tax Hacks and other retirement facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.